Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como. Today we're going to focus on canola. I know our first video we talked a lot about canola, but it is one of the more interesting commodities that we are seeing in Western Canada right now, and so we do want to put some special focus onto it. So I do think that these charts are looking a little bit bullish, and they continue to look bullish. There's some really nice things happening here in this marketplace that I wanted to point out. I don't want to become overly bullish because I do also believe that we should always look at what could go wrong, and we'll take a look at some of those things as well. Before we start, however, we want to talk about our subscription service. We'd like you to subscribe to our insights. It's only $99 a month. We won't try to sell you anything else, and you can cancel anytime. But in these reports, we also put our own biases, trading suggestions, target pricing suggestions, our proprietary fundamental analysis, and all the good stuff. So we limit what we put here on YouTube, but we give everything to our subscribers. So please subscribe at CanadianAgMarkets.com/subscribe to get our full story. All right, back to the July canola chart. Now, do want to mention that we're starting with July canola today because over the last couple of days, July canola has what I call flipped to the front month, meaning that there is more open interest and more volume traded on the July now than there is the May. That's not to say that the May is a dead contract, but it is starting to trend towards July being the more of the front month or more of the important contract. So we're taking a look at that a little bit closer today. We're also going to talk about the November here for a second. So just to look at this chart, for example, this chart is an excellent illustration of at least a good return after a bear market. We saw a bear market come into effect here from late February when the Chinese tariffs were announced to essentially when they were implemented near the end of March. And we've seen pretty much a rising market since then. There's a couple of indicators here that I think are important that could signal that we might be able to test back into these old highs area. One of those is that the 200-day moving average, which you can kind of see down here, this kind of faint little red line here, it has turned positive and quite positive, quite aggressively positive. It is not easy to turn a 200-day moving average positive. Basically, a 200-day moving average is the average of the last year of trade in a contract. So it is a very long-term average compared to these other shorter ones. So we think that is a positive as well. You can kind of see in the trend line here and how the 20-day moving average is likely to come up and meet that trend line at some point. We've also seen trade over the last 3 days. Although highly volatile, we've seen 3 up days in a row here. Today, we started off in the negative. We spent quite a bit of time in the negative, but eventually closed higher and again, making a new high. There's definitely some support under this market, and we wanted to point that out. It's cleared pretty much all of the, regular technical indicators here. We've cleared all of the other moving averages, the 20-day, the 50-day, the 100-day. Obviously, we cleared the 200-day quite a while back. But the fact that all of these are kind of turning and moving positive is also a continued sign of some support. Now, why would canola be seeing support? We're seeing a lot of negative trade in a lot of these markets. And so I wanted to kind of point out one thesis that we had about canola. Here is the ICE canola board crush margin chart. Now, this is a calculation made by ICE and by the Canadian Oil Processors Association of a margin. So it doesn't reflect cash margins, like what a crush plant actually makes, but it does give you directional bias on where things are headed and when margins are better and when margins are worse. So now, as you can see here, back on the 2nd of April, crush margins hit nearly $190 a ton. You can see that's the highest it's been at least since the beginning of the calendar year. If I back that off quite a ways, you can see that we didn't really see that kind of margins until last year at this time. So margins have kind of moved lower as we went through the early or late summer and fall. Was volatile at the beginning of the year. A couple of opportunities here to really layer into some business. And I think that's probably what we saw from crush plants recently. Now, that crush margin has significantly collapsed here in the last week, but the business that was perhaps done in early January and early March and now early April, if crush plants were locking in those crush margins, were selling the spread, or were buying or selling, or probably for selling some physical into the marketplace, they now have to go in and buy the physical from the farmer. Now, if we go back to these this canola chart here, you can kind of see that as the market was plummeting, there was not a lot of farmer selling participation. Even here at the end of November, there was not a lot of participation here from the farmer. There wasn't a lot of farm selling happening. A lot of selling happened as we moved through the fall, and as we saw this rally and even this secondary rally here in February. So, as this market collapsed and the crush margins climbed, not a lot of farmer selling happening, which means that the crush plants and the buyers had to go into the market now and incentivize some farmer selling. Now, the futures are starting to do that, but it's kind of compounding on itself now. So we are seeing, and I'll show you a little bit of a basis chart here as well. Just go back to our subscription page here for a second. This is just kind of, again, a trend on basis levels. Now you can see that there was a big collapse here in canola basis levels when the Chinese tariffs got announced. They recovered very quickly and have now been continuously rising and are kind of in that area now for spot that is, some of the highest that we've seen at least since fall. So we generally do see basis levels rise into the spring, which is, so there's a seasonal aspect to this, but also there does appear to be, incentives to farmers to open up the bin door and start some selling. We've seen some specials cross the tape and get texted out. We're moving towards cash positive basis levels. Now on this website, they're not reporting them as positive, but we have seen up to +$5, +$10 a ton in positive basis in the last couple of days here. So futures are participating with the futures market rally. Basis is participating, meaning the crush plants are paying up a little bit to try to get some canola sourced. Now that's the short, the long and the short of it. Really, we have some good technical signals. We have some good fundamentals that are backing it up, but we're also seeing, and I'll maybe pull up the November here. We're seeing some positive stuff on the November. Now, obviously, we've seen kind of an expansion of the spread between the November, from the May and July to the November. So we are seeing that there is a bit of an acute or a shorter term or a more nearby demand for the canola, which also supports the crush margin thesis there. So, good things are happening in the front month, not necessarily as aggressive on the November, but some of those same technicals are still now present in November, and even today's close showed that we did see the market move up in November canola today. It made a new high, albeit very slight new high today, above the high that we saw here on the 3rd. We're seeing some of the same things. The 200-day moving average is trending higher. We're starting to see the longer term. So this is the 20-day moving average. We're starting to see the 200-day moving average start to trend higher, and a lot of these other moving averages are starting to turn from their more negative or even more neutral stance to a more bullish outlook. So again, we probably have some resistance here on from this high that we saw on March the 7th at 646. And then, of course, the contract high here at 667. So there is some room there for November to canola to move as well, although it isn't moving as much in the November as the front months, as the demand does appear at this time to be more front loaded. Now, I want to talk about some risks or just some things that were affecting canola today. Obviously, we saw a good day of green on the board in a lot of markets. Here is May soybeans still carry the bulk of the open interest here. We've seen 3 days of gains in the May contract now. So we've kind of made back all the losses seen about the Chinese tariffs or the Chinese retaliation of tariffs to the U.S. Now, this could be kind of a kick the can down the road situation. China doesn't usually buy a lot of U.S. soybeans at this time of year. The old crop shipments have largely happened. We're starting to see South American supply come online. So their ideas around sourcing moves more towards South America. This is a normal thing that happens at this time of year. But as we move, 6-8 weeks, maybe even 12 weeks down the line, that's when we start to see new crop demand. So there still is some risk in the soybean market here, but we have seen 3 up days in a row. Now, one thing about canola that's been really interesting is that we have seen a bit of a divergence in some ways from some of the inputs that normally affect canola, which is, the vegetable oil complex. As you can see here, this is July soybeans. Over the last few days, July soybean oil has lost a significant amount of value as the tariff news and the retaliatory news came out. This morning, it hammered down just below the 61.8 Fibonacci retracement and has rallied back to a gain. So we ended, soybean oil in the green today, which is a positive sign. But canola throughout this weakness in soybean oil was rallying. So there was a bit of a decoupling or some divergence between canola and soybean oil, which is generally not the case. But when we see, today we saw some positivity in the soybean oil and that carried forth into canola, even creating higher highs. Some of the risks I want to point out, though, is there is, let's look at August rapeseed. Hasn't been super positive in the last little while. Canola can also track against rapeseed pretty closely. This market is in a bit of a bear market at the moment over the last week or so. That could eventually work its way into canola. But again, canola seems to have diverged a little bit from some of the other markets at this point in time, which to me at this point looks positive overall. I think once we start to trigger some very important cash price levels, we might start to see some selling pressure or at least some resistance. I'm going to go back to the July canola chart here. If we look at where that $15 a bushel mark lands, even with some recent 15 converted to ton, that's 661, right? So at even option basis or even basis, we're pretty close to that level right now. I have seen, again, elevators paying positives right now, so we might, be able to get to 15 before we get to that 661. That's very close to where we are now. So we might see some selling pressure here as the $15 a bushel, nice round number, farmers may have targets in that area. We might see it pull back a little bit. So that's my assessment right now. We are still friendly, this chart. It looks good at this point in time until that demand for what was booked when the crush margins were better is covered, which we won't know exactly when that happens. And also, how aggressively farmers sell when the markets get up to $15 for cash prices. So that is what we have for you today. Thank you for tuning in. This is only our second video on the channel, and we hope to do 2 videos per week. So again, subscribe to this YouTube channel, subscribe to our newsletters if you want more of our insights at CanadianAgMarkets.com. Have a great day.